you basically go back and look at when the baby boomers entered the workforce and said actually they had really great timing because the stock market had been in a funk for just about 2 decades, and they hit peak earnings at a pivotal moment.
That's right. Hi, Julia. What I think is interesting about this history is that in the 1960s, as the baby boomers were entering the workforce, the environment looked a lot like it does today. Stocks were expensive, interest rates were relatively low, and this set up this confluence of an environment where interest rates were set to rise, and thereby stock prices fell. And it happened, famously for a couple of decades. And so by the time the mid-1980s came along and baby boomers were sort of reaching peak earnings, they had a great entry point. And it seems to me that it's possible, and I think this is what millennials should keep an eye out for. It's possible that millennials will get that same opportunity because here we are, high stock prices, low interest rates, and the millennials will enter peak earnings in the next, let's call it 4 to 6 years, and they may have a great entry.
Yeah, and for a while, the baby boomers really benefited. The S&P 500, you said, gaining 8.8% annually from 1985 on. Talk a little bit, though, about how much the market now would have to decline in order to reach the valuations that we saw in the mid-1980s.
Well, that part of it can be a little bit scary. It depends, of course, on the valuation metric that you look at. I'd like to look at the CAPE, the cyclically adjusted price-to-earnings ratio, primarily because we have so much data. We have that CAPE ratio going back to 1881. And if you look at that, in the mid-1980s, the CAPE was at roughly 10 or 11 times earnings. Today, it's at 32. So for it to get back to where it was in the mid-80s, that fabulous entry point for the baby boomers, it would have to fall by roughly 60 to 70%. But we should note, it doesn't mean that it's going to, obviously. And it also doesn't mean that millennials have to wait around for it to get there. Every time that the valuation of the stock market goes down, that's obviously a better entry point than it was before.
Right.
And millennials are already seeing a 10% discount now.
They also wrestled with some pretty excitable events during that time. And when we had the 87 crash, the dot-com crash in 2000, and the financial crisis as well. So, I mean, you had to be pretty hardcore to hang on in there through those periods as well.
That's true, and it's worth asking, why, to the extent that the baby boomers were able to hang on, and I think a lot of them, at least some of them obviously did, why were they able to do it? And I think the answer is they had the benefit of seeing that huge bull market in the 1880s and 90s. I'm sorry, in the 1980s and 1990s, and boy, 1880s is going back a long way. And the thing is with the Gen Xers like myself and the millennials is we haven't really had the benefit of seeing that. We've only lived through those big 2 busts, 2000 and 2008. But there's hope because I think if the baby boomers were able to overcome the period from, let's call it 65 to 85, then I think the rest of us can overcome the last 2 decades and can get into stocks too.
Right. The millennials can also overcome too. Now, if they do take your advice and go in and buy in a big way here, there's a lot of cash sitting on the sidelines. We know that millennials save a lot more than, say, Gen Xers or baby boomers. Talk a little bit about, though, why there's somewhat resistance to traditional capital markets, to the equity markets.
Well, to me, that seems like, classic recency bias. The millennials are looking at their recent experience, and, 2008 obviously didn't help. And I think baby boomers are looking at their recent experience, and they're seeing that they made a lot of money in a long bull market, interrupted obviously by some declines, but a long bull market. And so the question is, can millennials overcome that recency bias? Can they look ahead rather than looking in the rearview mirror? And that's what I'm trying to encourage them to do. They should, to the extent that they get a good opening, and I hope that they will, they should look ahead and say, look, this isn't this isn't the 2000, 2008 environment where stock prices were high. This is a better entry point, and we should take advantage.
Yeah, and as you point out in your column, millennials, 57% of millennials are most unlikely to invest in stocks compared with 43% of Gen Xers and 33% of the boomers.
Yeah, which is quite fascinating, isn't it? Particularly given these guys, as you point out, are going to inherit an estimated $30 trillion from the boomers here. So, I mean, what are they going to do with it if they're not investing in
crypto?
Yeah, there you go.
Right.
Electronics, we heard yesterday, not diamonds. Not yesterday, Friday, gosh. Nir?
Well, it's going to be interesting to see what they do with it. One of the things I point out in the column is, there's going to be some tension for them because, they save more, as you mentioned, than Gen Xers and baby boomers. So they presumably have already more in the market at their age than their predecessors did at the same point in their careers. But also because presumably that $30 trillion, some of it is invested in the market. And so if the market were to soften more, they would see, let's call it their expected net worth somewhere down the line decline. And they just have to overlook that. They have to have faith that if the market does decline, it will recover, and that those values eventually will be there for them, say 20 or 30 years down the line. But that's going to be an emotional challenge.
Yeah.
Yeah.